Welcome back to Morning Markets on Wednesday the 5th of April. In today's video we're going to discuss two data prints which are informative of the pathway of inflation coming out of Europe and the US. Within Europe, we received an update on how much producers are receiving for the sale of goods and services with the Producer Prices Index. Prices in Europe are still going up, but to a much lesser degree than what we were experiencing through the summer months. For context, the year-over-year increase in February was 13.2%, and this is below the previous month's reading of 15.1% and actually undershot analyst expectations. If we were to compare those readings to July of last year, we were seeing annual price increases of around 43.5%. Since that time, we've seen 3.5% worth of interest rate hikes come through in Europe to try and cool demand, so it is starting to take effect in that regard. If we were just to compare that number month over month, we're seeing prices fall by around 0.5%. The biggest contributor here has been energy, most notably natural gas prices. Natural gas prices in Europe have cooled down from €340 per megawatt hour to around 46 at this point in time. So we've seen a material fall in European natural gas prices, now below the level they were prior to the invasion of Ukraine. The reaction from the European bond market yesterday was modest after President of the European Central Bank, Christine Lagarde, noted last week that they want further evidence to give them confidence that they are in sight of the 2% target. For context there, inflation in Europe is currently running at 6.6%. Across in the US, we had data around the jobs market. This is the Job Openings and Labour Turnover Survey, or the JOLTS. The Federal Reserve at this stage are really working hard to try and ease some of the pressure in the labour market. Unemployment rates are historically low, and we're seeing a huge amount of demand for workers. If we look at job adverts at this point in time, data showed that job adverts fell by 632,000 in February to 9.9 million, and this was below the expectation of around 10.5 million. Still a lot of demand there in the construction sector, but we're starting to see some easing in terms of warehousing and transportation sectors at this point in time. For context, previously we were discussing 2 job adverts for every 1 available worker. It's now to a level of around 1.7 at this point in time. So whilst this is encouraging in respect of easing the inflationary pressures, it does draw attention to what it means for the overall health of the economy, and hence the US stock market was marginally down on the day, but the bond market provided a positive return. What does this mean for us, and where do we go from here? Well, the data is really informative in terms of the pathway of monetary policy in both Europe and the US. Later in the week, we'll receive further data around the labour market, and we'll keep you up to date on those developments. Thank you very much for tuning in today.